At some point today, somewhere in the world, a finance minister will stare at a screen showing a simple number, dollars available, and that number will be lower than it needs to be. Not because their country is poor, not because they printed too much money, but because the world is quietly running short of US dollars. This isn't a headline you see on news tickers. There's no emergency press conference, no dramatic crash sound. But for emerging markets, this shortage decides whether currencies survive, companies stay open, or people suddenly can't afford food and fuel. And it's happening again, right now. The reason this matters is simple. The global financial system doesn't actually run on local currencies. It runs on dollars. Oil is priced in dollars. Shipping contracts are written in dollars. Corporate debt, government bonds, trade finance, overwhelmingly dollars. Even countries that publicly criticize US dominance still depend on it to function. But here's the uncomfortable truth most people never hear. The United States does not supply dollars to the world because it wants to. It supplies them as a side effect of its own needs. And when that flow tightens, the damage starts far from Wall Street. To understand this, forget cash. Forget banknotes. Most dollars in the world don't exist inside the United States. They exist as bank balances, loans, and promises created outside US borders by global banks. These are called offshore dollars. They aren't printed by the Federal Reserve. They're created when international banks lend in dollars. And that system only works as long as banks feel safe lending them. When confidence is high, dollars are everywhere. When fear shows up, dollars disappear. That's the shortage. It usually starts quietly. US interest rates rise. Global investors pull money back into US assets. Banks tighten lending standards. Nothing dramatic, just cautious decisions. But for emerging markets, those decisions are lethal. Imagine a company in Turkey, Brazil, or Egypt. It earns revenue in local currency, but its debt is in dollars. When dollars are easy to get, this is manageable. When dollars become scarce, the math turns brutal. Local currency weakens, dollar debt gets more expensive overnight. Refinancing becomes harder, then impossible. This is how solvency turns into crisis without a single factory closing. And governments aren't immune. Many emerging market governments borrow in dollars because their own currencies aren't trusted globally. Dollar debt is cheaper, until it isn't. When the dollar strengthens, governments face a choice no one wants to admit out loud. Spend scarce dollars on debt payments, or spend them on fuel, food, and medicine. There is no good option. This isn't theory. We've seen this movie repeatedly. Latin America in the 1980s. Asia in 1997, Russia in 1998, Argentina more times than anyone wants to count, Sri Lanka in 2022. Different countries, same mechanism. A dollar shortage doesn't announce itself. It squeezes, first through exchange rates, then through capital flight, then through inflation that central banks can't control because raising rates only worsens the shortage. At this point, international institutions arrive. Loans come with conditions, spending cuts, subsidy removals, currency devaluations publicly framed as reform, privately experienced as collapse. Meanwhile, the public narrative sounds very different. You'll hear that emerging markets mismanage their economies. That corruption is the real problem. That discipline was lacking. Sometimes that's true, but it ignores the structural reality. These economies operate inside a dollar system they do not control. The Federal Reserve sets policy for the US economy, but its decisions ripple across the planet. When the Fed raises rates to fight US inflation, it drains dollars from the rest of the world. Emerging markets pay the price first. Not because they're reckless, but because they're dependent. There's a quiet irony here. The dollar's strength is built on global trust, but that same strength periodically destabilizes the countries that rely on it most. And every crisis reinforces the cycle. After each collapse, countries try to protect themselves. They build reserves. They tighten capital controls. They talk about de-dollarization, but reserves are finite, controls scare investors, and alternatives to the dollar remain limited, fragmented, and politically risky. So the system resets until the next shortage. Today, the warning signs are familiar. Higher U.S. rates, stronger dollar, rising debt servicing costs, weakening emerging market currencies. You won't hear the phrase global dollar shortage on evening news, but you'll see protests over food prices, fuel shortages, sudden defaults described as unexpected. None of this is accidental. It's the result of a global system where money flows unevenly, power concentrates quietly, and risk is exported outward. For the U.S., the dollar shortage is abstract. For emerging markets, it's personal. It shows up at gas stations, in grocery bills, in job losses that don't make sense to people living through them. And here's the unresolved question that hangs over the entire system. How long can a global economy run on a currency controlled by one country before shortages stop being regional crises and start becoming something much larger? Because every time the dollars dry up, the consequences grow. And next time, the shock may not stay where we expect it to.